This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 160. Has monetary policy had its day?
Well, this week the Federal Reserve, the US Central Bank, is expected to lower interest rates as it grapples with low inflation and an economy that's starting to slow. But they're not the only ones. Wherever you look, central banks are pursuing easing policies. But does it make much difference when interest rates are already so low? We look at Japan, for example, as we ask on this week's Debunking Economics podcast, has monetary policy had its day? Now, central banks everywhere have interest rates at or near all-time lows. Let's look at the European Central Bank as an example, because they've just met. They decided not to change their interest rates. They probably will next time, but they haven't done it yet, even though they're concerned that Germany, amongst others, might be heading into a recession. Almost certainly are. We know manufacturing production is way down across Europe. But the ECB deposit facility rate, that's the interest they pay for holding money with their bank overnight, is minus 0.4%. So a high street bank pays the ECB to take their money, and it's been that way for 5 years. But the main refinancing operations rate, the MRO as it's called, is zero. This is how much banks pay when they borrow money from the ECB for a week or more. They pay nothing, provided they have the collateral. So, Steve, how can they go any lower when the ECB is actually paying the banks to borrow money from them? And we've got negative interest rates. That's happening in a few places, like Japan, for example. For the last 3 years, you have to go back to 2010 before you see them at the dizzying heights of 0.1%. How long is this going to go on for?
Indefinitely. I think I'd give it something, barring, of course, what I expect was this ecological crisis, a severe one, which will force us to completely forget about monetary constraints and go hell for leather to try to survive, help civilization survive. Until that happens, we'll have interest rates at zero, or in the central banks are trying to push it lower because, according to their economic models, that's the only way they can actually boost spending. Yeah. They enable to force negative rates on the public, not just on the banks, and with that, stimulate the economy. And I think
that's a nonsense, isn't it? That whole idea. I mean, if it's zero, or banks are, I guess the difference between not charging a bank and actually paying them to take your money, if they don't need it, they won't get it, will they? I mean, that surely is why we can look at monetary policy and say it's reached a dead end. I mean, the Taylor rule is obsolete.
Oh yeah, I mean it's. And that's the important way to frame this whole thing, because central banks have in their minds an equilibrium model of how the economy operates. And that equilibrium model, and I know I keep on emphasizing it, but I've got no bloody choice but to, that equilibrium model excludes the role of money banks and debt, money banks and credit completely. So that the real world where these things actually happen is what they're trying to manage with those policies. And their magic numbers have always been, and they look at the DSGE models, and the Taylor rule is part of this, is that they believe there should be a 2% rate of inflation, a 3% rate of economic growth, real economic growth, and a 4% rate of interest. Those are pretty much hardwired into their models, and they very reluctantly change them when they find things don't work out as they expect for some significant period. But that's their equilibric road. That's where it leads to. Those numbers 2, 3, 4, and what they're finding is they always expect to have to be pushing the rate of inflation down towards 2%. They thought they'd be having excess wage demands or raw material prices rising, and they'd have to find ways to retard demand so that the price level would fall towards the 2% target. Of course, they didn't see the financial crisis coming, hit them like a brick, and I know that from speaking to some of the modelers, in particularly in the Bank of England, but others, they're completely blindsided by the crisis. They were partying about how great their management was, one day saying, what the F was that the next? They still haven't revised the models to include the role of credit. But now the one thing that I find, this will be a bit of the bend your mind part of the podcast, that there is a tendency when you include credit in the system, there is a tendency for rising debt to get falling inflation heading towards a negative, and that's the situation they're in. And now they're trying to boost demand by actually turning interest rates negative for depositors.
Right, give me that again. So we've got rising debt. So inflation falls because, well, I guess, explain why that's happening. I guess if we've got more debt, we don't want to spend as much. So that keeps prices subdued.
This is the mind-bending part of it, because one thing which came out of my very, very simple model of Minsky's financial instability hypothesis, I said that without actually falling over my own tongue. Was an unexpected outcome, that the increasing level of private debt was actually paid for by a lower workers' wage share of GDP. So I had a model in which the only borrowing was being done by firms. The firms were using that money to build factories. They were not doing Ponzi speculation. And if there was a low level of capitalist desire to invest, then you would slowly converge towards an equilibrium. In a hunky-dory situation, a constant low level of private debt, a constant wages share of GDP, and a constant employment rate. So there's a stable equilibrium in there.
The utopian vision.
Utopian vision. Now, when I amped up the desire to invest, which of course is a positive thing, you want capitalists to want to invest. This is a capitalist system. It is one because they invest and innovate, and you want this to happen. When I ramped up the investment rate, two weird phenomena started to happen. The first was that there was a period of diminishing cycles in employment, and what I was using at the time, a proxy for inflation, also diminishing cycles in the cause of inflation, which in the model ended up being the wages share of GDP. And then the fluctuations and in the background, what you had was a rising level of debt. As the rising level of debt got more extreme, those diminishing fluctuations turned into amplified ones. So a period of diminishing cycles gave it a period of rising cycles, and ultimately a breakdown when the level of debt reached a level that the capitalists who were paying the interest bill on that debt didn't have enough of the share of income to finance it. And the reason that's failed is because the workers' share of rate of change of GDP couldn't fall as fast as the bankers' share was rising. And in the middle of all this, before you reach that crisis point, the firm share, the capitalist share of income, was fluctuating around a constant level. So the capitalists, from their point of view, everything was stable. In the sense, it was cyclical, but cyclical around a horizontal constant trend in their income share. What was going down was wages share of GDP as the banker's share went up. And that is it's called an emergent property of a complex system.
It is complex. So let's get at the risk of asking you to repeat yourself. Let's go through that step by step. So we get to the stage where capitalists want to invest. So what's the repercussion? Take me step by step by that,
okay.
So I can keep up.
For members of the Patreon audience listening to this, if you go to the download page I put on profstevekeen.com/Patreon, I explain this verbally in the Can We Avoid Another Financial Crisis?
Yeah.
You'll find the electronic version there. And so what goes on with you, you start from an initial position. I can start from, say, zero debt, which is where I start the model from for simplicity's sake. So zero debt, and say 70% of income going to workers and 30% going to capitalists, which was the historic share back in the 50s and 60s. Then you have a desire by capitalists to invest more than they get in retained earnings. And it's because if you fall in the wages share, more is going to capitalists, there's more willingness to invest, and they want to invest more than they have in retained earnings, they have to borrow money from a bank. When they borrow money from the bank, that therefore means they've got to pay interest on that. So part of the income is now going to bankers, and there's been a decline in the amount going to capitalists. As the boom continues, it drives to the point where there's a shortage of labour. And if I generalise, there's a shortage of raw materials and things like that as well. But just in a simple, pure model, just the three-class model, workers, capitalists, bankers. Shortage in labour, meaning that work capital have to pay more to entice the part of the workforce that is not working into employment. So you start getting rising wages share, and the rising wages share combined with the increased amount of money going to the bankers means that capitalist share falls below the level at which they wish to invest more than they earn. So they start investing less than they earn, which means they start paying their debt down a bit. It also means the level of investment drops and the economy starts to tank. Yeah. And then as it tanks, you get a falling wages share because it falls below the point, employment falls below the point where workers are getting wage rises, they're now getting wage cuts. That starts to restore the banker's share, to the capital share of income, to get them back to the stage where they want to invest again. So this is the turning point, the bottom turning point in the trade cycle. But when you have when you start with a high desire to invest, each time you go through this boom and slump cycle, it starts with a higher share going to the bankers because you have some accumulated debt that was borrowed during the boom that is not completely paid off during the slump. So you get a ratcheting up of the debt level. Now, if you think about, and again, in a very simple model, you have, say, a fixed rate of profit at which capitalists wish to invest more than they have in retained earnings. Let's say it's a 3% rate of profit, which in the model that I use, where I've got a 3-to-1 ratio between capital and output, that actually translates as a 9% profit share, which is a lot. You know, when they start with 30, they've got you have an investment boom starts off when they get 30%. So they're happy with a 3% rate of profit and 9% share of GDP. No matter what the remaining 91% is divided up between whoever. Well, when it's all going to the workers, then the workers are getting, 91% of that, 0 going to the bankers. Through one of these cycles, a certain amount of additional debt is accumulated. Let's say it's 10% of GDP is the debt level. That's, you've got to pay interest on that. So that interest is subtracted from output, and wages are also subtracted to give you that same level of profit with a lower wages share and a higher bankers share. And this continues happening cyclically.
Right. So So we're at the bottom of that then, aren't we? But although, I mean, we're seeing those signs, aren't we? In that we're seeing growth slow, we're seeing debt rise, and we're seeing inflation low.
Yeah. So, and this is when I wanted now to take a leap from a simple model to a slightly more complex model, and that's where in that model
I was worried you might do that.
I thought you were. Yeah, okay.
Because my question was going to be, before you do that, my question was going to be, if we're at the bottom of that cycle, if it's a cycle, what is it that turns it around?
Well, it's just the cycle. Each extreme, it's a change in the distribution of income. When you get to the top of the boom, wages, which have been leading up to the boom, have been falling, start to rise, and that rise in wages share plus the money you're paying to bankers means the amount going to capitalists falls below the level where they wish to invest more than they have in retained earnings. So that's the turning point in the boom. The turning point in the slump is where wages have fallen sufficiently that the share going to capitalists is restored to the level at which they wish to invest more than they earn. So they start borrowing money from bankers again. And that's the turning point at the bottom. And that keeps on happening all the way through the period of cycles, a number of cycles, not just one.
No.
And with a higher desire to invest, each time the boom and slump reaches the slump period, the level of private debt has risen above what it was at the bottom of the previous boom, the previous slump. And so you get a ratcheting up effect over time.
Right. So a central banker would say, well, that's fine. Obviously, when you're at the bottom of that cycle and you want to drive that investment, then you want interest rates to be low.
No, it's not. That's not what happens, because, and this is why they're getting the more complex model. First of all, the central bankers aren't even looking at this, and certainly before the crisis, they just completely ignored the level of private debt. That's one thing why I take my hat off to the Bank of England, the Bundesbank, one person in the RBA, Clark, I think it is, and the Norwegian central bank, for admitting that they should have credit in their model to that. Haven't yet done it.
Right.
But anyway, they're not looking at that at all.
And the Fed's doing this big review, haven't they, of where monetary policy's gone wrong?
Oh, yeah, but I mean, who have they invited to it? Anybody from
Same old crowd.
Where's my invite? I must have misplaced it.
Good point.
It's just the same old bloody crowd. As much as I've had good dealing with Olivier Blanchard, he's about as radical as it gets inside there. And, one of my friends said Olivier's a DSG man through and through. He has a hot rod. He can do the 0 to he cover the quarter mile as fast as anybody. You put a corner in the way, he's in deep trouble. And that's that. He's the best of the lot. They're asking about what to do in terms of how to change monetary policy. So not going to get there.
But they are looking at employment, aren't they? This and that's obviously, I mean, okay, they're ignoring debt, but the role of employment is part of this. So even the RBA, for example, are saying, well, we know that we're not going to get inflation kicking in till we see tightening in the labour market. We need to keep a closer eye on that. So
this is the point about what the low inflation and low interest rates, because they're puzzled as to why we're not getting any increase in wages demands, despite a high level of employment. And you can make statistical arguments about that. So like in Australia's case, for example, the level of underemployment is about 3 times the actual recorded unemployment rate. And America has a similar, not as big a gap, but a similar gap. So it's partly that there are so many discouraged workers who haven't yet been brought back into the workforce that as an unemployment indicator looks great, the employment indicator doesn't look so fabulous. So it's partly the employment rate being the issue. But I also found when I generalized my model to include price dynamics, I then also had a little factor that the rate of interest had a base component which was set by the central bank, and then an inflation-adjusted component where, with a lag, the banks would react to a high rate of inflation by upping their margins so that their real rate of interest was positive. If you don't have that adjustment, then there'll be periods where the real rate is substantially negative. And with that adjustment, what turned out to drive that margin was also the wages share of GDP. Now, when you got to the stage of an extended amount of private debt, which is where we are in the real world, of course, with that extended rate of private debt, the distribution of income switched between bankers and wages also had the side effect that because I had 3 factors determining my wage level, by the way. I better explain this, and this is going to get slightly head spinning. Phillips did not have a linear Phillips curve, point 1. Bill Phillips, who gave us the idea of a relationship between the level of economic activity and the rate of change of nominal wages, he also had the rate of change of the unemployment rate as an important factor there, and the impact of imported inflation, what he called a wage price spiral. This is completely left out of the conventional treatment of Phillips. It pisses me off to see people say Phillips curve has died. There was no Phillips curve. There was a Phillips surface. And that's completely ignored by the mainstream. Phillips didn't actually mathematically model that because A, he didn't have data, and B, he was working with a handheld calculator, a hand-operated calculator. There's no way you could have crunched the numbers back in 1957 to include the 3 factors, so he just stuck with just one. Now, when I include that in the model, what I get coming out of it is a period of deflation. So you have as the wages share of GDP falls, the rate of inflation also falls, and you get to the point where you have, in my model, negative prices, negative price change, deflation running at about 2%. At that rate, you no longer have the inflation adjustment for interest rates. All you're stuck with is the base rate. Now, the base rate, the neoclassicals don't quite understand why, but that has been falling ever since Volcker put it up to about 17% back to stop the high inflation of the 1980s. And the recession that caused pretty much broke the power of workers in America. And of course, we also had at the same time the entry of China into the global market. So another massive deflationary force, because prices determined by American labor was being replaced by prices determined by Chinese labor, paid 1/15 or 1/30 as much. So we had all these deflationary tendencies in addition to ones in my model coming into the real world. And now that base rate has gone zero. And the negative is just we're discussing, and they can't understand why not pushing the economy up. They're not looking at the debt burden that's sitting on top of it. That's completely ignoring the elephant, not the elephant in the room, the elephant that is sitting on the capitalist in the room.
Right. So until that debt is eradicated, then this idea that Taylor's idea that inflation is linked to interest rates, or economic growth is linked to interest rates, we can just throw that out the window.
Yeah, we can. I think this is, mate, I've sometimes think you've probably read more textbooks than more economic theory than I have, because you did write about Taylor's model as well. Taylor was, when you first...
Man is still alive, who was, for a short while, was part of the advisory team for the current president. So
and he's still taken very seriously in American economics as well. Yeah, what he basically said was, if you take a look at the policy of the Fed, you can actually model it by a little rule that says they have a 2% rate of inflation target, and they change interest rates at roughly twice the rate of the change of the rate of inflation. And that sort of retrospectively modeled what the reserve banks did, and they ultimately made it their model of what they should do in the future as well. And the belief was this would actually keep the economy on an equilibrium path. Now, of course, as usual, as a neoclassical model, Taylor's model had no role for the private sector, no role for credit, no role for debt, no role for money. And unfortunately, we live in the real world, and those things matter.
And he's not an advocate of government intervention, really, either, or stimulus.
Yeah, totally anti, yeah.
And yet, doesn't that seem like? I mean, let's the obvious answer obviously is let's try and eradicate debt, but that's not in our lifetime, Steve. Unless your work is immensely successful, and let's hope it is. There's not going to be any idea of a debt jubilee. So we have to. Central banks have to work with what they've got. So, and they have tried with stimulus. They've tried with quantitative easing. Although increasingly, central banks now are saying, well, actually, it's not up to us. It's up to governments. They've got to put stimulus into the economy, like Donald Trump did. Now we can criticize Donald Trump for pushing the U.S. government into debt, or the fact that his tax cuts favoured the wealthy rather than the people who really needed it. But I mean, it looks like that that sugar hit has helped the US economy, and that they're doing a little bit better than the rest of the world. And I wonder how much of that is because he pumped all this stimulus into the economy.
Oh yeah, that's true. I mean, the sugar hit is a pretty good way of describing it, because it certainly wasn't it wasn't a protein boost. Because all the money went to the wealthy, but the wealthy spend a bit. There's the occasional yacht they buy. Saw some monsters in Sydney Harbour when I was there, by the way.
Yeah, it's a lot of money.
Oh my God! But anyway, that's spending. Hires workers to give them the 50 staff or so to manage the yacht. It hires workers to build the yacht in the first place, et cetera, et cetera. So that spending does spill over a bit into the real economy, but it's about a 1 for 10 bug. Every trillion you get in, maybe you get 100 billion out. And rather than getting a multiplier, you get a divider in terms of the impact. But it has had an impact. But of course, their vision of what would happen was, and you can find Bernanke on this and Greenspan as well, the wealth effect. And the idea was, as we drive up share prices, and that was the literal part of the objective, all this crap about it not being objective, you just read what they had to say. The reason for QE was to get a wealth effect. As people have more, the assets are worth more, they tend to spend more. That will stimulate the real economy. Now, of course, if you really want to stimulate the real economy, you give it to people who are poor.
Yeah.
They spend 100% of it. You get a dramatic increase in the circulation of money, and that gives you far more bang for your buck. You'll get, out of your trillion, you might get 1.5 or 2 trillion of stimulus. But you pour it to the rich, you give them $1 trillion, you might get 100 billion or 200 billion back, but you still get it. But of course, it's far less effective than they expected. And it also has increased the level of inequality that we got in the boom in the first place. So,
well, it's a crazy idea. I'm sure you're right. It wasn't the stated intention, but it was the intention to push up the share price. And Donald Trump has been saying, "Hey, look, isn't the economy great? Look how our equity markets are going." But I mean, that is a bit of a nonsense, isn't it? Because they will reach a point. I mean, first of all, it's a very small proportion of the population who are benefiting, but it'll also reach a point where they're going to, fundamentals are going to make investors go, well, look, we're not going to push any more money into the share market because our price to earnings ratios are all out of skew now. So what do? They put the money in something else, like property, I guess.
Well, it's basically inflated asset bubbles. I mean, the American market bottomed at. I love the S&P. The fact that it bottomed at 666, that was cute. What is it? More than 3 times that. It's risen that much in the meantime without any substantial change in the fundamentals. So what you now have is, as Robert Shiller points out, is the highest price to earnings ratio on American shares outside the 1929 bubble and the 2000 bubble. In fact, it's even higher than the price to earnings ratio in 1929. So if you're looking at the market and you're a value investor, you think, what the hell am I doing here? If you're a trend investor, you have one answer, and that's the 4 words: don't fight the Fed. But what it means is then what the Fed does becomes incredibly important to maintaining the value of that market. So we see back at the end of last year when the Fed decided it would go from quantitative easing to quantitative tightening, oh dear, didn't the market have a problem? And that volatility then, which as it happens, some of the hedge funds that use my ideas were very thankful to see that turn up. That volatility scared the hell out of the Fed, and it went back out and pulled out of quantitative easing.
And yet,
tightening, pardon me.
Yeah, and they may go back to quantitative easing. Well, certainly, I mean, later this week we're going to see what the Fed is going to do. The expectation is that they are going to drop interest rates. I mean, there's been some talk that they might drop interest rates. What they're calling it an insurance move, but there is some question as well if the data's been so weak lately, maybe they should drop it by 0.5%, which they haven't done for a long, long time. But it sounds like from what you're saying, it doesn't make any difference what they do.
Well, it does, but not the difference that they want, nowhere near the bang they want for it, because again, their vision excludes the role of private debt.
Yeah.
So they are thinking that, look, when I model this with my Minsky software, people have seen the loanable funds model that I've got on the website numerous times. In that model, where you have banks as financial intermediaries, that's just the vision that neoclassicals have of them, massive change in the level of private debt make bugger all difference to the economy. You can ignore it. It's just one of those, why bother things about it, because the intermediary role means that the change in the amount of money in the economy only affects aggregate demand if the person receiving the money has a higher propensity to consume than the person lending the money. And then, as Bernanke himself said, outside implausibly vast differences in the marginal propensity to consume, pure redistribution should have no aggregate economic effects. When you change that to, and that's what the model have got in their heads, so they don't worry about the level of debt. But in the real world, where the banks are extending the money and creating it by the loan, and the interest rate rises, if you have a low level of private debt, that doesn't matter all that much. But if you have a high level, which we have right now, like America's level is 1.5 times GDP, private debt is 1.5 times the size of GDP, that increase in the interest rate seriously affects your willingness to take on more credit. And consequently, people stop borrowing the money, the credit demand falls, and the economy goes into a funk. And that's the cycle that they're in now. And I had to say it, but I predicted this back with the first edition of Debunking Economics in 2001, that the world would turn Japanese. This is the situation Japan had been in now for the last 25 years. Yeah,
exactly. And how do banks make money out of all of this situation? Banks seem to, do well at making money, but obviously all of this creates a problem for them, which central banks are very aware of. Because low interest rates, well, who's going to save any money anymore? We don't do that anymore, do we? Haven't really done that since the 1980s. We borrow rather than save. But if interest rates are so low, then with nobody depositing anything, but also the banks not making money out of the loans they give because interest rates are so much. And if they have got any excess money, let's take the situation in Europe. If they want to park it in the European Central Bank, they've got to pay 0.4% to park that money there. So it surprises me that banks are actually making any money whatsoever, but they seem to be recording enormous profits.
Yeah, it's the Ponzi scheme side of what they finance is giving the profits, which is why they're so fragile. And
because their argument, their thinking would be, and this is why we've seen marketing taking over banks.
They're buying shares. They're buying shares because that's where they're getting a positive return. So they're not making money out the loans anymore, as you're saying. They're not making as much because,
well, for a while they were making the loans bigger, weren't they? They were saying, well, making such a small margin on these now, we've got to do twice as many.
That's basically it. You've got a volume. This is again where understanding the bank creation of money is so important. In the loanable funds world that neoclassicals think in, there is no volume component for the profits of banks. It's all a margin. They make a profit out of the difference between the interest rate they pay for deposits and the interest rate they charge on loans. In the real world, where they create money, then there's two factors. It's how much money they create and that margin. So if you've got a small margin, you can finally make up it by having a large amount of credit creation. But in the aftermath of the slump we've been through, credit creation is far smaller it was during the boom. For example, America's running at about a credit level of between 7 and 5% of GDP right now, declining in response to the interest rate rises. Before the crisis, it was 15%, and of course with higher interest rates as well. So the volume side of the business is much more, it's almost gone for the banks compared to how it was before the financial crisis. So what they're doing is they're buying into the stock market. They're making money out of the rise in the asset value, the dividends that are coming back from those shares. They're buying back their own shares, et cetera, et cetera. So that's a very fragile basis on which to have sustained profits. And that's why, even though I don't see a serious recession coming in terms of a credit slump, I do think the banks are incredibly fragile now because they are really dependent upon the central bank continuing to inflate the asset markets, which is the real way they're making money right now.
Yeah, which can't go on forever, obviously.
It can, unfortunately. This is the danger because, again, coming back to the creation of money thing, the central bank has and Bernanke said this, and Greenspan said it as well, has an unlimited capacity to create money when they're buying assets off the financial sector. So what happens during things like quantitative easing is that the central bank is buying and selling bonds off the private financial sector all the time in what are called open market operations to try to keep the interest rate on reserves within their target band. which is, like in America, I think the bottom was about between 0.25 and 0.75. Now it's, up to about, they tried to push it up to the 2-3% level. It's going to come down from that. But that's what they're doing the open market operations for. And in the sum, if the open market operations mean they buy more bonds off the private banks and they sell back, then there's money creation, which goes into the financial sector. In quantitative easing, they promised that they would be on the buy side of open market operations to the tune of $80 billion per month, which is roughly $1 trillion per year. Now, that, of course, meant that with the financial institutions receiving that money, as financial institutions can only buy other assets with them. They can't buy bonds because the government's buying $1 trillion net per year of the bond creation. So they buy shares, and partly they buy property as well.
Right. But my point was that can't go on forever, because property will reach a point where people go, as they have, that these prices, the price has now escalated so much it's just ridiculous. And similarly with the share market, people will be looking at the price to earnings ratio and say, well, this can't go any higher because it has no semblance in reality, and there's an underlying value here which hasn't changed.
Yeah, well, the property market, I think I agree with you on that front. But the share market, the Feds, if you look at the demand for shares, it's the volume of money coming in versus for buying versus the volume going out for selling. If the financial sector is as it was during QE, effectively providing $1 trillion additional volume on the way in, then you've got a buy pressure which overrules the whole issues of fundamentals and so on. And if the Federal Reserve is determined enough, it can keep on doing this indefinitely. It has bottomless pockets for the creation of money.
So much greater demand, same number of shares.
Yeah, and that what you mean is, and of course also you've got share buybacks happening at the same time.
Yeah, so less shares.
So there's less shares. So you've got a real effect driving up the price, and you've got to the stage where the PEs are crazy. Yeah. Anybody looking at it, I'm not going to go for PE, but hell, the prices, if the Fed continues buying, the price will continue rising. What do I do? And that's where the old saying comes in, don't fight the Fed.
So a final thought then. Tell me if this is a stupid idea or not. We know that the ECB is looking at the the idea of tiering their interest rates. So, and they're just saying this because they don't want banks to face a negative interest rate for their excess money. So they're thinking, well, maybe we'll offer a different rate for them. But couldn't we also find a way where we actually tier interest rates, to differentiate them basically depending on how the money is used? So we offer higher interest rates for deposits, and this could be done through the central bank, but is the way that they could pass this thinking onto high street banks. So you offer a higher interest rate for deposits, so encouraging people to save, and if they're doing that, then they may be less inclined to put it into Ponzi schemes. Lower rates for loans. So people then may say, we'll start thinking, well, okay. And the only reason you offer lower rates for loans is because you don't want to make the market collapse because people have got so much in debt. And I guess over time you could gradually increase that. But if you had that differential, then people might say, well, hang on a second, I'm carrying this big loan. I'm not paying a great deal for it. But if I deleveraged and started saving, then I'd be getting more money that way. And could you shift the balance by banks doing something like that?
No, right. Because
I thought it was a great idea when I was doing it. One word, all that thought.
It's because you will, that's happy. This is the whole problem of the idea of saving at the individual level applied to saving at the national level. Because when you save, what you're doing is deciding to spend less money. So your expenditure falls. And therefore, if your income remains the same while expenditure falls, you'll get a positive difference, which you call savings. But if you clarify by imagining a world in which money is constant for a period of time, if you have more of that money in your bank account, then by definition, everybody else has precisely as much less. So your saving causes dissaving by other people at the aggregate level. The aggregate level of savings is zero. What you do by encouraging savings is slow down the turnover of money.
Yeah, because well, the banks do something with it, of course, but of course they don't. That just means, in fact, more money is going to. In fact, I presume that's the case. Don't we have increased savings? Then more money is still going through the finance sector. They win whichever way you look at it.
Yeah, well, they're getting out of the finance sector that actually matters, and this is what the main role of government bonds is. And when you don't actually have government money creation, the government bonds which is sold to the financial sector, liberate money that's in the financial sector and circulate it to the real economy. So those sorts of roles are there. But I think, mate, this is going to be me saying we should leave this one for a bit later because we're running long on time. We haven't really hit on one little point. So this is a point for a second podcast. what's with these negative rates? Why are the central banks charging negative rates to the private banks? And what would they like to have happen after that? And that's a very interesting story. I think we should cover in another podcast.
All right. Well, tell you, okay, we'll do that in a couple of weeks then, shall we?
Yeah.
We'll move on.
I think we had an interesting change. We sort of moved away from that negative rate thing.
30-second answer to the final question then. What should, obviously part of it is in their models, they need to be studying the role of debt in all of this. If they did that, what would be the policy tool that they would use?
Here we go back to the modern debt jubilee. That's the only tool. You've got to find a way of reducing the private debt burden, because that's what's causing the private sector to spend so slowly. And if you don't get that down, then you won't get a boost to the economy, and you won't get out of that income distribution trap either. But of course, as you said at the beginning, the odds of that are somewhere close to zero. So they won't do that. And that's why they're trying to encourage the governments to go into fiscal policy, because they're saying our monetary side is not working.
Yeah, absolutely. An admission to failure. Absolutely. All right, very good. We'll catch you again next week. Thanks, Steve.
Okay, thanks.
And I hope you enjoyed that as much as we did, clearly. That's it for the Debunking Economics podcast for this week. I'm Phil Dobbie. He's Steve Keen. See you again soon. If you've enjoyed this podcast, then please share it with your friends, like it on YouTube, and subscribe to this channel.